Welcome back to the What's More podcast. I'm your host, Quinton Harris. You're dialed in for episode 234. So in this episode, a couple of things we're going to talk about. Obviously, a big gut punch here on the CPI index that came out on Wednesday. Let's talk about the reevaluation of what the Treasury is doing to offset some of these hits we're taking. It's a pretty interesting concept that the U.S. Treasury Secretary Bessent is doing to kind of offset some of these issues to drive down the 10-year yield. And then also finally talk about burying the hatchet. I think that's pretty important. Anytime you get an opportunity to do that in life, it's a pretty cool thing you can do. And I had one of those moments myself this week. So all that and more in this episode at What's Your One More. All right, so here we are. CPI week came out. Like, we had all the momentum, all the dominoes were lined up, everything's going our way, and then gut punch today. Today's Wednesday, the 12th. So this episode is going to drop on Monday, the 17th, on the holiday. So yeah, obviously by the time you hear this, the producer price index will be out and retail sales, but it will all, for the most part, be irrelevant, right? We were chasing the CPI index, even though it's not the Fed's favorite form of inflation. Everything was lined up for us to kind of really start to push that 10-year Treasury down and get into that, really below that 4.4 mark that we were looking to get in the 4.3s and, really just kind of set the stage for this next rate cut. Now, if you were to look at the anticipation of a rate cut from here on out from the Federal Reserve, it's probably at zero after this report because it just came in hotter than expected. There's some lagging shelter components inside of this, along with some other items that kind of spiked, if you may. But again, it's lagging data, and we're going to talk about that and break it down. And I'm going to show you some charts here. If you want to go to our YouTube channel at What's Your One More with the number one, at What's Your One More with the number one, you'll see those charts as we get to them in this episode. But hey, we were looking at a number that was going to come in around 0.3 on the month, and it came in at 0.5, which is higher. And so that increased the overall headline of inflation from 2.9 to over 3, and that's not where we wanted to be by any means. And so, the core rate also came in higher than expected, and so that's not where we wanted to be. And it took the core reading from 3.2 to 3.2 year over year. And again, that could kind of cause for some concern, right? And especially off of Powell's comments the day before, where he said, hey, inflation's getting under control. This doesn't give you that feeling if you're, if you're an investor, if you're in the bond market. This is not what you want to see, and the market's reacting accordingly to it here at the end of the day. There's been a little bit more settling in, but there's some things in there that, are just they're when you see them, you go, yeah, that's kind of obvious. I mean, so I'll pull up some charts here as I'm talking with you because I think it kind of adds to the commentary that we got and also adds to the notion of what's going on. So again, check out these charts at What's Your One More on our YouTube channel at What's Your One More with the number one. But as I dive into this here, a couple of things that really jumped off to me that were like, boom, this was the leaders in the camp that kind of offset this. Energy was higher than anticipated. The cost of energy had gone up quite a bit. Food was one of the biggest components inside of this. Obviously, shelter is the largest component. We'll break that down in a minute. But food makes up about 13.7% of the CPI, and it was up higher than anticipated month over month. And with the largest component of that being from, the eggs. Obviously, the cost of eggs. You've seen this on the news with the bird flu and things that are going on. I just didn't anticipate it would be at this level to kind of raise and bump this up. Because when you look at the culprits of raising the cost of the CPI and what led to it, it breaks down pretty simple. It was motor vehicle insurance, used car sales, shelter being the largest component. I'm going to get into that in a minute, food and energy. And that is what really kind of caused this reading that we got because everything else was really lower than anticipated. And so when we look at core, obviously we talk about that and what that means, but the core headline is when you take out food and energy, right? And so shelter inside of that core reading makes up roughly just under 45% of that. And the shelter is made up of three different metrics, right? What's the rent going on in the world, as well as the owner's equivalent of rent, and then lodging away, like your vacation rentals, et cetera. The challenge with this reading that I saw in here is that it's lagging. We've been talking about that for some time. And, if you look at the core logic component that's more real time and up to date, this indicator is half of what this reading was, which would have put the whole CPI in line where it should have been. But for whatever reason, we're still using lagging indicators as a component of that. And, another challenge on this is just the owner's equivalent of rent. We talked about how dated of a metric that is, picking up the phone and surveying an audience like, hey, what would you rent your house for? That's always going to lead to just skewed numbers, because you always got someone that goes, I wouldn't rent my house for less than this. And so these are challenges in the readings. But again, even with all that said, we know how that's worked. We know how this component is made up. There was not just us There were several, if not all, of economists thought that this thing was going to come in lower than expected. And if you just look at the 3-month run rate and the 6-month run rate on this, and if you look at it just without the lagging indicators in there, we would have been in the 2s, right where the Federal Reserve wanted to be. And so this was just kind of shock. I think it was shocking to everybody here, and it's not a good stance for the market. All markets are feeling it today, and it's going to take some settling in of this to get back where it needs to be. And settling in over the next couple of weeks, we did have a Treasury auction at the end of today that helped a little bit, and the bonds have settled in accordingly instead of the overreaction because of that. But there's also something else taking place in that bond market, if you may. For example, I mentioned earlier in the intro, the U.S. Treasury Secretary. Now, here's a concept that you got to give a hats off to this administration if they decide to do this. If some of the stuff we're talking about on the podcast interests you and you're like, hey, Q, I want to be a homeowner. I want to buy an investment property. I want strategies on how I can take advantage of the market. I have a solution for you. And that solution is Loan People, to where it's all about the people getting the loan and the people doing the loan. You guys know me by now. I've been doing this podcast for years, but I've been in the mortgage business for 23. And it's very rare you can find a company that has a mantra for loan officers, by loan officers. And what does that mean? That means you have a company that's designed to help provide the best atmosphere for loan officers possibly imagined. And not only that, the most efficient operations for those loan officers to be successful, which provides a better customer service. And that's what you get at Loan People. So much so that they put that in the company name. And at the heart of this is the people. It's in-house processing, it's underwriting, it's closing and funding. And why choose them? They got great rates. They close on time and they have award-winning service. So check them out at loanpeoplejacks.com. That's loanpeoplejacks.com. So, the United States has an abundance of gold, right? They have some gold that they have over the years, and they have valued that back in 1973 at $42.22 an ounce. Like the value of the United States gold with the United States Treasury is valued at $42.22 an ounce since 1973. It's never been revalued. It's never been called what we would call mark to market. For example, mark to market means you mark the value of that to the current market value of what it is. So if you go back, what is that, 50 plus years ago, we haven't changed the value of what we have in gold. We're still undervaluing that based on today's value. So if you were to take the current value of a gold ounce compared to what it's been valued at for many years at $42.22, it would go from $42.22 to roughly $2,900 per ounce, thus giving an additional valuation of anywhere between $800 and $900 billion worth of capital in the United States government's budget. That's a large number. And what in turn that would do is allow the United States Treasury to not have to issue as many treasuries, specifically 10-year treasuries. And this is one of the tactics that the Treasury is using to drive down the 10-year. Bessent himself said, hey, listen, it's not our stance to tell the Federal Reserve they need to lower rates. Matter of fact, we think they're doing a great job as is. I think this is something that, now I'm speaking into, I think this is something that's pretty interesting the way they're handling this. Because I thought by now in the administration, you might have Trump versus Powell. You're not having that right now. They seem to be in lock and step because even Trump came out and said, I think they did a good job. They shouldn't have lowered rates. And I think that's interesting because that's not what many of us anticipated. And now you've got the U.S. Treasury Secretary, Bessent, coming in from behind saying, hey, listen, I think they're doing a great job. I'm not here to tell them what to do. What I'm here to do is to get the 10-year yield lower. Now, if you've listened to our show and you've watched our forecast or even our episode we did on how a long-term mortgage rate is made, while it's not made necessarily by the lowering of the Fed funds rate, it is necessarily compiled of the 10-year Treasury plus the spread. And the spread we broke down is the risk variances that a servicer or investor would have on the mortgage-backed security pool. And we talked about those risks and the threat of prepayment penalty, default, and cost of servicing that pool. The 10-year, however, is a large component that can be oftentimes the major component of dictating that, meaning that as the bond market deteriorates, right, and it gets worse, the higher the actual yield on the bond goes, thus raising the mortgage rate. But in this particular case, what Bessent is suggesting is that if we can control how many treasuries we issue based on our fluctuation of raising this gold price of $42.22 an ounce to the market rate of $2,900, let's use that as an example, we're going to create all this additional influx of capital, so therefore we don't need to issue as many treasuries. Now, like anything, if you don't have to issue as many, that means there's not enough supply in the market. You're not technically flooding the market with them, because if you flood the market with a product, in this case treasuries, the value of that treasury is not going to be as valuable as it could be if less treasuries were in the market. And so since bonds are inversely proportional, the way they work, the less amount of issued treasuries that are available for the market space to buy, the more valuable they become. Thus, the yield goes down because they don't need to raise it as much to make them, don't need to have as high a yield to make them as attractive for people to buy. And I think that's really important, because if they pull this off, again, this goes back to the commentary we've said many times. The Federal Reserve isn't going to have to lower interest rates for that 10-year yield to get better, or the spreads to get better, thus making the lower mortgage rate happen without the Federal Reserve having to move the needle as much. We have suggested that if this combination of the spread getting better, without even knowing what Besant had cooking over there, that if the spread got better, and then if there was a lowering of the interest rate from the Federal Reserve Fed funds rate, that could cause a compound effect and make it better. But this whole thing about mark to market on the gold as standard, and mark to market on the gold that the U.S. has at the Treasury, this is an interesting dynamic, because this is something that I don't think any of us saw coming. And it's a pretty brilliant move. Now, it's a one-time needle mover. I think that's really important. You can't keep doing this over and over again. So I think the timing of this has to be really good. Coming off of this CPI index that we got, I don't know if that's the time you do it, but I know that they have already thrown and casted a net out there. This is what they're looking to do. And maybe this is like an entry point of, you say, okay, listen, how do we jump in and do this? Is it now? Is it when we get better readings? Is it when we know the Federal Reserve might be suggesting they're going to cut rates? When is it? I think if these things happen in accordance, we could see that drastic lower we've been talking about, even with a bum reading like what we just got. And I think that's unfortunate. And again, I'll stay tight-lipped on this, on some of these readings here. But other than that, I will say this. It's unfortunate. I think it's a one-off. I think what we see coming down the pipe, the shelter at some point is going to show correctly. It's not going to continue to show these lagging numbers. And I mean, and the food component, yes, I know you could say, hey, listen, I had someone tell me, hey man, I went to Subway, I spent $14 on a footlong. Like that's inflation at its best. I agree. So I know food's inflated, but I'm talking about in this particular case, like the egg thing is really leading that food component. And then shelter is being driven by lagging data. And I think when that data catches up and it's not such a lagging effect anymore, we'll see more of that realized core number that I keep talking about, that's without shelter, that the actual run rates are a lot different than what we're seeing right now. The last thing I wanted to end on with this podcast is kind of had one of those cooler moments of the week for me personally. And I don't know, many of you may be in a situation like this, but I'm sure at some point in your life you've had like a conflict. Maybe it's been a disagreement. Maybe it's just been a complete divide, whether it's with family, friends, colleagues, or maybe someone that was once a colleague that's no longer a colleague, or maybe you felt like someone has done you wrong in your life. And we've all been there. And in a particular case I had with a gentleman that lasted way longer than it should have. And it all surrounded business. Typically those business ones are nasty. I'd say family's right there with them as well. But kind of reached out of the blue and called me up and said, hey man, I don't like the way our last conversation ended. And more importantly, I'd like to, have a better one with you and bury the hatchet. And, it's kind of one of those weird things where you get that kind of comment and, balls in your court at that point. So we set this meeting up and, on Monday evening, I got a chance to sit down with someone that was a friend of mine for a long time ago. For many years, we went through a lot together. And then over the last 12 years, it's been a very distant relationship, almost one that was, which like you could call very volatile. Like sometimes even in public, it wasn't good, like the amount of dislike there. And I think going into this meeting, one of the things I thought about was that, I talk about this on the show, so that's why I bring this up, is I think one of the challenges with today's world is that we don't have to agree with everyone and their opinion and their stance, but we should respect it. And, and it's one of those things where it's like, if we say that on here, if you're going to talk the talk, you need to walk the walk. And so, I think it would be very, hypocritical of me to say those things and then not actually do them. And this is one of those moments where I could actually act on what I was saying. So getting the opportunity to do that. And as I sat down with this gentleman, that's one of the things I talked about was, hey, listen, no matter how this conversation goes, at the end of the day, like, we've got to be able to have our own opinions and express how we feel about those opinions, but then also respect each other's opinion. And it was a really cool meeting. I got a chance to sit there and listen and hear everything he had to say about, our business ventures and how they went, and how that made him feel, and where he was in his life. And I think I just kind of seek to understand in order to be understood during that moment. And about a couple hours later and a couple of beers later, it was one of the cooler moments that I've had, because it was a closing of a chapter in my life that I'm so glad is behind me. And I'm also glad that it ended in where I could potentially rekindle a friendship that I had lost from 12 years ago, and having it back again, just because I needed to sit down and understand someone else's point of view, and also respect it and have the same thing reciprocated from me. Cool moment. And if you ever get a chance for something like that to kind of be mended in your life, highly recommend it, because obviously life's too short, and obviously carrying things like that don't need to happen. And you can always have things understood without it being said. And I thought that was really important. So guys, I hope you're having a wonderful week here at What's Your One More. And thanks for tuning in. If you like what you're hearing, please share it. Please put us on your Spotify or Apple playlist, 5-star review us. Check us out on our YouTube channel at What's Your One More with number 1. My producer, Charlie, will put all this in the graphs. And I hope you guys are having a wonderful holiday here on this Monday. And we'll be back next week at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.